Guys, working class, especially those in the civil service, when you go out and take a loan, it could be from a bank or a microfinance lending institution. How much interest are you paying back on that loan over the course or the tenure of the loan that you've just contracted? Why is this question important? Well, it is important because you need to understand what exactly you're attaching your name and signature to before you sign that loan contract. Why? Because you might just spend the rest of your life paying back debt. And so it is very, very important for you to understand exactly how interest works. So now, how exactly does interest work? Let me show you. So guys, before we even begin talking about interest, we need to understand the types of interest that there are. There are basically two types of interest. There is simple interest, and then there is compound interest. Simple interest, as the name suggests, is simply calculated on the principal or the original amount of a loan. Okay? And then compound interest is calculated on the principal and the accumulated interest of previous periods of that loan, and can be referred to as interest on interest. Now, you'll be intrigued to learn that most, if not all, banks and financial institutions use compound interest. The reason why is because this is the most profitable. Now, how exactly do we understand how compound interest works? This is what applies on your loans, and we have to understand how it works. So we'll do this with an example. Let's start with example 1. Imagine you borrow 1,000 kwacha from a microfinance company with a monthly interest rate of 20% to be repaid after 1 month. How much interest and principal do you repay? Well, this is a simple example because the period is only 1 month. Therefore, the amount of interest to be paid will be found by multiplying the principal, which is 1,000 kwacha, times the interest rate, which is 20%. Remember, this interest rate is a monthly interest rate. It's not an annual interest rate, it's a monthly interest rate. And this is what most microfinance institutions charge. So 20% of 1,000 kwacha will give you 200 kwacha. The 200 kwacha qualifies as the interest. Okay, and then the principal is 1,000 kwacha. So at the end of the month, what you pay back is the interest and principal of 1,200 kwacha. This is what you pay back. Simple and straightforward. The real issue here is when you introduce time to your equation. When there is a time factor to your borrowed amount. So, as in the second example, we're taking the same 1,000, and now we're introducing a time period of 4 months. Remember, the definition of compound interest is interest that is calculated on the principal amount and accumulated interest of previous periods. And this is where we will see this apply. So to best demonstrate what exactly is going on here, I'll quickly draw a table so that we can follow through. So we have month 1, month 2, month 3, and month 4, and then we have the principal, we have the interest, we have the total, payable, we have how much you are going to pay per month because it's a monthly installment loan, and the ending balance. Alright, so let's start. For month 1, our principal is 1,000 kwacha. What is our interest? Remember, our interest is 20%. So 20% of 1,000 kwacha is 200 kwacha. How much is our total payable at the end of month 1? It is 1,200, simply by adding 1,000 plus 200, the same as in the previous example. Okay, but we can't pay the 1,200 in 1 month. Why? Because we have elected with the financial institution to say, okay, you can subtract maybe 400 kwacha because I cannot manage to pay the whole 1,200 in a month. So to make the loan easier for me, I request that you subtract or you deduct 400 kwacha from my pay every month for the next 4 months. Alright, so in month 1, instead of paying the 1,200, we decide to pay 400 kwacha. So what is the amount remaining as our ending balance for month 1? You subtract 400 kwacha from 1,200, and your ending balance for month 1 is 800 kwacha. This is how much you owe as at the end of month 1. Then we cross over to month 2. What was your ending balance in month 1 becomes your opening balance or principal in month 2. So you start with an 800. And then you calculate 20% of interest on your 800. 20% of 800 kwacha is 160 kwacha. That is the interest on the new principal of 800 in month 2. And then the total payable in month 2, when you add 160 kwacha plus 800, will give you 960 kwacha. This is how much you're supposed to pay in month 2. But remember, you have asked your lending institution to deduct 400 kwacha. So we make a payment of 400 kwacha, right? Good. And then your ending balance, when you subtract the 400 kwacha from 960 kwacha, will give you 560 kwacha. Your ending balance is moved on to the 3rd month as your beginning balance of 560. Again, the interest of 20% is slapped onto your 560 kwacha as opening balance in month 3, and your interest for that month is 112 kwacha. What is your total payable in month 3? You add 112 kwacha plus 560 to get 672 kwacha. But again, you are only paying 400 kwacha. Okay, so subtract 400 kwacha from 672 to get 272 kwacha as your ending balance for month 3. Repeat the cycle. In month 4, our opening balance is 272 kwacha. When we apply an interest rate of 20%, we get 54.4 kwacha as our interest for month 4. And then what is our total payable amount in month 4? We get this by adding the principal and the interest to get 326.4 kwacha. What is the payment? Well, remember, we have been paying 400 each month, but this time around because the total payable is 326 kwacha, we're not going to pay 400. We're going to pay the remaining 326 kwacha to get us our ending balance, which is 0. So, after finishing your loan in 4 months, how much would you have paid in total when it comes to interest? Let's add these up. We add 200 plus 160 plus 112 plus 54.4, and the total will be 526 kwacha 0.4. This is just the interest paid on the loan amount, the original loan amount of 1,000 kwacha. So now you see the difference. If we paid this loan back in a month, we will have only paid 200 kwacha as interest, and the total payable will have been 1,200. However, when we stretch the time to 4 months, the total interest that we end up paying is 526.4 kwacha. The reason being is, as I explained in the beginning, we are using compound interest as opposed to simple interest. If we were using simple interest, we would have ended up paying the same interest, whether it would be in a month or whether in 4 months we would have paid the same interest. But money is always subject to time in today's financial system. And so, the longer you hold the bank's money, the more you pay in terms of interest. So sometimes when you are asked, how long do you want this loan to be? And you say, I want it to be 5 years long in terms of tenure. Mentally or psychologically, you think that you are being done a favor because you are paying back small amounts. Well, that is not the case. When you look at the amount of money you will have paid back by the end of 5 years, you will have paid back even 2 or 3 times the amount you originally borrowed. That is how compound interest works. The longer you hold on to the bank's or the microfinance institution's money, the more you pay back in terms of interest, as we have demonstrated in this example. So if you have to get a loan, if you find yourself in a situation where you absolutely have to get a loan, make sure you pay back this loan in as quickly a time as possible in order for you to avoid paying the excess amount of interest, because money is always subject to time in today's financial system. It's called the time value of money. The longer you hold on to the bank's money, the more money they make from you, as we have demonstrated here. 200 kwacha in terms of interest versus 500 kwacha in terms of interest, simply because of a difference in the time. So please be wary, be financially smart. Make sure you understand exactly what you are going into when you sign those loan agreements. Do not borrow for consumption, borrow for investment. And before you go and take out a loan, please ensure you consult a licensed financial advisor that will be able to advise you on what strategies you need to take in order for you not to end up in perpetual debt.